Hello, everybody. My name is Alan Ellman, the Blue Collar Investor, and welcome to this video I've titled Setting Up Option Portfolios Using Stock Selection, Diversification, Cash Allocation, and Calculations. Now, over the last few months, we've had quite a number of new members joining the BCI community. And one of the common questions that I've been getting from these new members is how do we know how to set up our option portfolios? What basis should we be using? So in this video, I'm going to be using 6 covered call writing trades to show you how to set up and establish your option portfolios and creating a lower risk in terms of our returns. So that said, let's get started by showing you an overview of what's going to be included in this video. So first you have to know, well, how much cash do I have to allocate to this particular portfolio, and how many securities am I going to use? In this video, I'm going to be using 6 different stocks and ETFs and $150,000 cash available. Now, all of these rules and guidelines will apply to smaller portfolios and to those much larger. So they all will have application. We're going to be using several BCI reports that we provide to our premium members. 3 reports: a stock report, which is provided on the weekends, our midweek exchange traded fund report, and our weekly blue chip or Dow 30 report. So we'll take 3 from the stock report, we'll take 2 from the ETF report, and 1 from the blue chip report. We're also going to be using a few spreadsheets developed by the blue collar investor, and that's located in our store. And I'll provide links for you associated with this video. The first spreadsheet you'll be seeing after the reports is the portfolio setup spreadsheet, which will take into consideration diversification and cash allocation. Then, as far as calculations are concerned, you'll be seeing our trade management calculator in action. Let's get started with the 3 reports for the 6 securities we're going to be using. This is the weekly stock screen and watch list. Now, all of the screens are located in this top blue bar you see across the top of the screenshot. And the 3 that I selected, I'll just give you the tickers: APH, NXT, UHS. Now you can see that first of all of them are in bold, which means that the technical indicators are all bullish, every one of them bullish. So that's certainly a great start. Now you can see also that where we got them from. Well, 2 of them were from the IBD 50. APH, for example, ranked 13th. But when you see other, that means it came from our very own database BCI has developed over the past 18 years. Now, as far as the industry, we want to make sure we're well diversified. So the report will also give you the industry. As an example, UHS in the medical industry, and the ranking, either A or B in the case of these 3 securities. Now let's move over to the mean analyst rating. You could see that they rank between 1 and 2, 1 being the best, 5 being the worst. So those are all excellent. And they all have up arrows on balance volume, meaning more cash flowing in on up days than on down days. All bullish signals. As far as the option liquidity is concerned, 3 Ys, that means yes, good liquidity on the option side. Earnings reports do not impact this particular expiration cycle, nor does the ex-dividend date. So all good there. Let's move on to the 2 that we're going to select from the exchange traded fund report. Well, we select elite performing securities, relative strength ratings of 60 or higher, meaning in the top 40% of all securities, non-leveraged, which means low risk securities for the most part, and that have outperformed the S&P 500 in both 1 and 3 month timeframes. Okay, so adequate liquidity, relative price strength very strong, non-leveraged, and we selected BITQ, a Bitcoin ETF, and IAU, which is a gold ETF. So those 2, along with the 3 from the stock report, And finally, from our blue chip or Dow 30 report, I selected Intel, which at the time was the best performing over the last 1 month of the 30 Dow stocks. You could see here, for example, in the last month, Intel was up 49.9%, while the S&P was up 0.4%. Okay, so those are the 6 securities. Now, this spreadsheet, you go, wow, Alan, I can't read a darn thing here. Well, I want to give you an overview, folks. So, section 1, which you'll be seeing in the next screenshot, you enter the initial information, 150,000, 6 securities, and this yellow cell here, as you'll see in the next slide, will give you a guideline as to how much cash reserve you should have for exit strategy implementation if necessary. Section 2 is just instructions. Section 3, where you enter the information in the blue cells and the white cells will appear automatically. Down on section 4, you'll get your initial calculations. We won't need anything further. Those will work out great. But if you need adjustments, you can make them in section 5 and 6. All right, here's section 1. We enter the data for the expiration cycle expiring in December 19th, 25, which is coming up in a couple of weeks from when I'm making this video. When I made it, there were 40 days to expiration. Here we enter the 150, 6 securities, and it says leave about 3 to 6 grand in cash reserve in case you need exit strategies. It could be a little more, it could be a little less. And don't forget, you're going to get plenty of income selling the options as well. Now, in section 3, we enter the 6 tickers. You know, the first 3 were the stocks, the next 2 were the ETFs, and then the Dow 30 Intel. 6 positions, 150K. We're going to allocate about 25K per position. We fill in just the blue cells, price per share when we're setting up the portfolio, and we enter the industry to make sure we're not duplicating industry segments. The spreadsheet will then tell us, well, let's look at APH, for example. With 25K, 142.64 per share, we could buy 175 shares, but with options, we do it in 100 share increments. So the spreadsheet will automatically round it up or down, depending on if it's above or below 50. In this case, 175 is rounded up to 200, which means we're going to sell 2 contracts. How much will 200 shares cost? 28,528. Spreadsheet will then add up the cost of all the shares, and it comes to 146,113, leaving a cash reserve of 38.87. That works out great. Remember, we were looking for 3 to 6 grand. If we had to make adjustments, we have sections 5 and 6, but it's not necessary. All right, now I want to show you another spreadsheet, our trade management calculator, which will let us know if we could generate the kind of returns we're looking to generate, somewhere between 1% and 4% a month, depending on ETFs or stocks, if I were doing these trades. Some people want to go more conservative, some want to go more aggressive, but that's where I stand. Usually 2 to 4% is my sweet spot, a little bit lower to ETFs. So in section 1, you're going to see we're going to enter the initial trade. And in section 2, we're going to get the initial calculations. And in section 3, you're going to get the initial calculations for the entire portfolio of all 6 positions. Now, what you're not going to see is section 4, which has over 20 different exit strategy adjustments inherent in the spreadsheet. And then section 5 gives you your post-adjusted returns per trade, and in section 6 per portfolio. We also have the opportunity to make notations regarding our trades in our covered call trade journal. If you're doing puts, we have a cash secured put trade journal as well. Great learning tool when we go back and evaluate our trades. Okay, here we go. The 6 securities you see on the far left, the industries where the red arrow is on the left side. The entry date was November 10th, the expiration date 12/19. Remember, it's a 40-day trade. And we enter the price of the stock or ETF. I used all out of the money strikes, which I would use mostly in normal to bull markets. And then the option premiums here. And then remember the number of shares as used by that portfolio setup spreadsheet, 200, 200, 100, 900, 300, 700. Here's our returns. The calculator will tell us, hey, if taken through contract expiration, it's a 40-day trade. The yellow cells in the middle tell you break-even price points, price of the security minus the entire premium. Now the brown cells is what gives us our initial trade calculations. So let's look at the bottom one now. That was Intel, generated a 40-day return of 4.13%, 37% annualized, with an opportunity, if Intel goes up to the out of the money strike, of another almost 10%. So we have an opportunity with Intel for a max return of about 14%. It just goes to show you what some of the opportunities with these types of securities. All right, you'll notice that the lowest returns, the 1.9 and the 1.61, those are the two ETFs. So ETFs are baskets of stocks. Some are going up, some are going down. Typically, as a security, the implied volatility of ETFs is lower than that of individual stocks, and therefore the premiums are a little bit lower, but so is the risk inherent in each trade. Now you can see the upside potential in these purple cells pretty significant. Let's look at our entire portfolio after the initial trades are executed. Total number of contracts, 24. Total premium generated, this is our starting point, $44,587. Now, if every stock goes up to or beyond the out of the money call strike, we can generate another $12,087. That doesn't mean we will, but we can in the best case scenario. So we can possibly generate $16,674 in those 40 days. How much did we spend? $146,113. Remember, we had that cash reserve. The flat return on the option side is 3.14% if the price of the stocks just stay exactly the same. But if they go up, if they all go up to the out of the money strike, over an 11% 40-day return. Of course, if they go down below the break even, we can start losing money, and that's where our exit strategy skill set must kick in. So let me summarize now how we could minimize the risk in our portfolios when we're setting them up. Select only elite performing stocks. I showed you the 3 ETF reports we provide to our members. Make sure you diversify not only stock and ETF, but also the industries that they're in. Allocate a similar amount of cash per position. They'll never be exactly the same, but you want to be in the same ballpark. Make sure the calculations align with what your goals are. That's where the trade management calculator comes into play. And then once you've entered your trades, now you're ready to go into position management mode. You must have that position management or exit strategy skill set ready to go. May not be necessary, but if it is, you have to be prepared. So when we're setting up, I showed you several of our spreadsheets, the ETF stock screen and watch list, the ETF report, the blue chip Dow 30 report. We use the portfolio setup spreadsheet, the trade management calculator. All of these are found in the BCI store under best packages. I'll leave you links for those as well. Now, you also have to be prepared for your exit strategy opportunities, and the trade management calculator has all of those exit strategies inherent in the spreadsheet. So there you have it, ladies and gentlemen, especially for those of you new to the blue collar investor. We welcome you to our BCI community, and I hope this video will give you a structure, an idea, as you get better and better and more confident, how to set up your portfolios to minimize the risk. And so actually management of our portfolios starts even before we execute our initial trade entries. So ladies and gentlemen, thank you very, very much for taking the time to watch and listen to this video presentation, setting up our option portfolios using stock selection, diversification, cash allocation, and calculations. Hope you enjoyed it, but most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.